So guys, it's no surprise we're still sitting in a pretty bad spot on Bitcoin. If you want it to go up, if you want it to go down, maybe it's a good spot. But the reason being is still the same. We're looking at where the liquidations and stop losses are resting, and for the ones on the long side, they're starting to group. Oops, sorry, wrong color. They're starting to group on the bottom side, as you can see. It's been that way. Now you can make the argument that yes, there is liquidations and stop losses sitting on the upside, but currently as price stands, we are making lower highs. So we're going to follow how price reacts. Of course, if we start to rally higher, this will bend the structure as well. So, just so we're all aware, these kind of movements day to day don't seem too significant, but, you know, potentially they could break the higher time frame structure, or at least change it temporarily. So again, guys, we're just looking at where the invalidations are for futures traders. Of course, there are going to be spot traders who have stop losses, but we're not too concerned about the top side, right? Because we're more so looking for short traders on the futures market. That being said, we're kind of sitting in the middle of the range, a little bit closer to the bottom side. So the better trade here is probably to try and look for a long. However, we do want to keep in mind that while the higher time frame structure is up, the structure that we've been printing locally hasn't been looking that great. At least for the people that believe the market will continue to go up. That being said, though, I want you guys to also take a look at the Dixie here, because the Dixie is struggling, so it is starting to fail these levels. We had a retest of it, making a lower high. Well, we made a couple lower highs so far, so if we continue to make lower highs and lower lows, what that means is assets should rise in prices. So whether you're a stock trader or crypto trader, commodities, whatever, if the Dixie does trend down, this is good for anybody who wants to bet on asset markets going up. So always have a look at the Dixie. If this continues and we do start breaking down the structure, expect the stock market to recover. It's already recovering a decent amount, so let's have a look at the stock market. Yo, what up, Leo? I was watching a VOD. There's something important at the very end. VOD from Friday? No, the VOD from Friday, I pressed Alt F4 to get rid of marbles, and I must have Alt F4'd twice because then it just closed Streamlabs, which kind of fucked it up. So there's probably like, I don't think I uploaded the second VOD because it was just like a couple minutes before I rated Mr. Low's stream. So no, you didn't miss much. Alright, let's have a look at the ES. It's starting to regain, so the stock market is pushing up again. If you guys want to have a better understanding of, you know, the relationship between the money supply and the assets, all you have to do is take a look at the ES, which is the S&P 500, and then you want to look at the DXY, the Dixie, which is the US dollar index, and you can see that as the US dollar index went up, the ES went down, and as the US dollar index is starting to fail now, the ES is going up. And this is similar for Bitcoin as well. It's not going to be as clean or as pretty, but the general trend is going to be the same. And the US dollar index is the biggest market out of all these, so of course it's going to have some influence on asset class. It's basically just basic economics, right? When we look at scarcity, you know, the more money that's added into the supplies is likely to increase the scarcity of other items just because the natural laws of supply and demand. I'm not really teaching this that well, but a basic economics professor or even a YouTube video could probably explain it to you. Inflation is not the craziest concept, right? Let's imagine that we could print more gold, or that you could do that, artificially create gold. And then everybody had gold jewelry. Well, do you think gold jewelry would be that expensive? Probably not, right? Because you could buy it from somebody, and the seller side of the market is just heavily outweighed. I'm not doing a good job at explaining this, but it's just basic inflation, okay? So as they add more money into the supply, asset prices become more rare relative to that supply of money, and generally will increase in price. Now, Tesla had a pretty good day today. I don't know if you guys saw this. Pretty strong rally from Tesla. Still, though, I don't know if this is going to lead to anything greater. Obviously, we had a pretty big pullback on Tesla. So locally, not a bad move, but still the general trend, I wouldn't necessarily trust this move. We did take out the local stops right before going higher, so odds are we could come up and take these levels out, but in terms of coming and making an all-time high, that's still not something that we should be discussing. So one step at a time basically means we have to wait for them to gain certain levels, and after they do this, then we can start to have the conversation about this. But having the conversation about this before we do this is just a waste of time. Because it's really hard to know or predict that far in the future into the market. The further you go, the more speculative it becomes. Of course, all predictions are speculation, but in terms of having higher of a probabilistic edge on your speculation, you typically want to wait for local things to happen. So there's not much of a play on Tesla here. I believe we were waiting for sub 100 on Tesla, so we're waiting for all these players to be knocked out of their positions, right? This is a huge invalidation point. So where's the most obvious stop loss for people betting the market is going to go up? The outlier in the data is the trough or the low. So now what we want to wait for is these people to lose. We want to make sure that somebody absorbs these losses, however. So price action normally says if you make a lower low, the trend is down, which is typically the case. It really just depends on how significant the low was. So in some cases, the low isn't going to be that significant. And how do we know? Well, this is a bit arbitrary, but you're going to try and identify the most recent outlier in the data, the low. You could also use this because you're going to argue between, okay, why is this low, why is this low? Just group them together, okay? Because everything in the market is technically a zone. It's not a precise line. The reason why everything is a zone is because that's how orders are placed by big dogs. They're all staggered, right? So they stagger their entries, they stagger their profit targets, they stagger their losses, like a ladder. Now, within these zones, there's going to be a part where the most clustered amount of stop losses exist, and that's going to be usually a good spot to have an exchange of liquidity. $68 test on Tesla? No, I don't know about $68. The main thing that you want to wait for is you don't need to jump into Tesla. This is a good rally on the day, but it's not the first rally that we've seen that's been strong in this overall downtrend, right? They're still making lower highs. Now, there are going to be rallies in a downtrend because things don't go straight up and they don't go straight down. As far as when it comes to do I think that the retail brigade has enough money to get through the supply zones? Probably not. So I'd want someone to come and put on a lot of risk and absorb the losses. So remember, if you're the biggest trader, what is your issue, guys? Your issue is getting your orders filled. So opportunities where we have outliers in data make it very obvious as to where a lot of invalidations are existing. Invalidations meaning non-restrictive orders, whether it's in the options market, particularly for Tesla, is probably going to be one of the biggest traded. It could be CFD futures. It could be spot as well. Obviously, spot comes with stop losses if you're trading common stock. So we're looking for everybody to lose, and then what are we waiting for? We're waiting to see how price reacts, because one of two things is going to happen, right? The stampede is either going to overrun the liquidity provider. So if the stampede overruns the liquidity provider, then we'll likely just go lower. If someone steps in and absorbs all these losses, because what are we assuming? We're assuming that non-restrictive orders are resting at the outlier in the data. Okay, that's the assumption we're making. That there are stop losses and points where people want to get out of their bet that the market is going up. Okay, so if we don't keep going down but we come back into range, making a relative insignificant lower low, that's telling you two things, right? The first thing it's telling you, which is probably the more important thing, is that the trend is slowing down. This is just how your intuition should view these kind of things. Remember, when we take out lows and we go and find a new low, we're looking at the relative distance between these lows. Okay, so when we took out these lows previously, the move down, Jesus, is about a 50% move down. Okay, so when we take out these lows, I'm looking for a move that is less than 50%, showing me that the selling pressure is slowing down or buying pressure is starting to pick up. Because this could be the potential of a trend reversal. And why are trend reversals so important? So that we can stack our runners, have a swing position that goes and runs. Those swing positions that go on and run are going to pay for a lot of the losses that it takes to get those kind of positions. So remember, guys, if we have tight risk reward, we're going to be getting stopped out a lot. That's just part of trading. You can try and look at that other stuff sitting at the beach. There's a lot of retail tools that exist. I don't personally believe in probably 99% of them. So if you want to go and do your own research and find out on your own whether or not they work, that's up to you. But if you want my opinion on it, the only thing I look at is the price for the most part. But no, technically the only thing you need is the price. And it seems kind of stupid, right? Like, because why wouldn't I just use all these fancy indicators and stuff? But a lot of these indicators, first off, the people that try and use them do not understand how to use them. Nor do they understand the more important part about trading, which is trade management, risk management, and the psychology behind trading. That is all much more important than, trying to determine where the market goes next. Because you could be really good at charting and know where the market's going to go next to some degree, to a not for certain, but with a probabilistic edge. But you can still not make money. And the reason why is usually comes down to you're not looking at your long-term risk reward. You care too much about that individual trade winning because you hate losing, that you're willing to sacrifice a lot of the principles when it comes to cutting your losses quick and letting your winners run. That's usually the only shot we have at trading at the retail level. So our best shot at trading at a retail level is to have to undergo that certain risk-reward regimen, which is extremely difficult because you're losing more trades than you're winning. And losing trades sucks, right? We all hate losing trades. But at the same time, it's something that's going to happen to you, to Goldman Sachs, to anybody who ever participates on the market. And the reason why is because there's always lurking variables that cannot be accounted for. Hedge funds and funds in these big firms will try their best to hit every single variable they can. When it comes to geopolitics and local domestic politics, they'll try everything they can to get every variable. But in the market, there's always lurking variables, no matter what. So there's no way to have the full picture, and nobody has the full picture. Because all it takes is a couple market participants to be very greedy or to be very fearful at any given time, and the structure of the system they have in place breaks down. And this is why we always have to use stop losses. So from the top down, nobody has the full picture. So we always have to protect ourselves from these lurking variables, from these random news events, from random traders doing something stupid. These kind of variables will always exist. So when it comes down to it, we have to really define our risk. And what we're looking for is one of these variables to play in our favor. So when the market becomes... It's hard to define what it is, but when the market becomes what you could argue is irrational, meaning volatility just skyrockets, we want to be in a cheeky position in order to take advantage of that skyrocket of volatility, because those runners are going to pay for all the losers that it takes to try and set those up. Do I recommend funded accounts for crypto? So the big thing with funded accounts is you have to pay attention to the spread. So, the funded account is going to be using, they're using someone else to provide that liquidity, right? And so there's going to be spread, spread being, the difference between where you wanted to enter the price and where you got filled on the price. Same thing, and the spread will affect your stop losses. It'll also affect your profit targets, so you got to be careful on that. But the way you would do a funded account is very similar to the way you would manage a regular account. And the main thing you want to pay attention to is risk management. So let's say that you are brand new to managing a 100K account. So you pay for a 100K account, right? You're not risking 1K per trade, because I think the max drawdown for most of those is like 5% or 8%, somewhere in that range. So this is where you'd have to scale back on risk management heavily and actually learn how to manage one of these accounts, right? So what you do is, instead of doing 1K risk, you go super low risk until you start to find a groove and a rhythm, because you're going to be trading on probably a platform you've never traded on before. You're going to be trading with spread, and you're probably not used to trading with spread. So, go to 0, 1%. You could start with $10 of risk per trade. until you get comfortable, and then you can move it up. But you're going to blow up a funded account really quick because you don't have experience with the emotions of seeing those high numbers go up and down. And you might, you know, start to fuck with your live trades. And what happens when you fuck with your live trades, guys? We shouldn't be looking at them. You should just be letting them either run into targets or run into stop loss. When you're sitting there staring at it, a lot of the times you're going to fully close a position. And why is that bad, fully closing a position? Because we know that we're going to have losers. We know that we're going to lose trades. That's a given, right? So we can't just close our winners just because it looks like a lot of money. Okay, we can close a good amount of them, a good amount in profit, but what happens if that thing keeps going? A lot of the time, if that thing keeps going and you only have 10-20% left in it, it's going to make you more money than the money that you thought was a lot when you closed it. Particularly when we look at perpetual contracts, right? Perpetual contracts give you that edge where the exchange isn't just really trying to churn out volume. If the exchange is really trying to churn out volume, they're going to have contracts with expiries, right? Because then people have to open another position or trade again. So it increases the exchange's volume. But if you have perpetuals, then you have the advantage of just having a runner that runs for a while. Okay, thanks. I was just wondering if you eye at this. Like, your style of trading the most and pretty successful so far because I understand the background. Okay, good. Yeah, I mean, the thing about it, trading is you're going to have a lot of positions that get stopped out, but that's why you use risk management. And the way that you make it long term is that sometimes things get volatile. And if you're in a position that is in favor of this volatility, that's going to pay for a lot of the losers that it took to get that position. And that's why I tell you guys, no trade is special. The individual trade is not special until the market shows you that it's special. So we still have to practice the same trade management regardless. And when I say the market's showing you that it's special, I don't mean you being on the 1-minute candles and seeing huge moves in your favor. You still have to zoom out and look at the overall structure because the market doesn't go straight up and it doesn't go straight down normally. ETH Bitcoin had a little bit of a rally. It's struggling today. So why do we look at ETH Bitcoin, guys? We look at ETH Bitcoin because if Ethereum does good against Bitcoin, that's going to give the altcoin market a little bit more dominance. So if we see that, right, we obviously know there's a lot of opportunity on the upside of altcoins when they get going. You can go look at the historical charts of when altcoins kind of had their pop-offs. You know, there was one in 2018 or early 2018, and then there was one in 2021. Or 2020, I should say. Around that time, altcoins had their little run. So I know a lot of people are waiting for that opportunity because obviously a bull market in the altcoin index is going to be a lot of money for everybody. I mean, it's pretty hard not to make money in a bull market, right? Keep in mind, though, when these things happen, everybody's going to be a genius, okay? So everyone's going to come out of the woodwork and say, oh, I know I have the best trading strategy. I know what I'm doing. Because when the market is up, everybody's doing good for the most part. You basically have to really overtrade and over-manage your trades to lose in an uptrend. So everyone's going to come out and say they have the winning strategy, this, that, the other. But just remember that making money only on the upside is not how a trader functions in the long term. You also have to bet on the market going down. Why do you bet on the market going down sometimes? Well, I mean, first off, the setup might be founded in the liquidations in the chart and the manipulation that you see within the price, so it might just be a good trade to take nonetheless. But more importantly, what you're doing is you're covering yourself in a war zone. You're taking a short because, or you're betting that the market's going to go down because you already have positions in profit that the market's going up. So you're just adding a little bit of a buffer just in case things turn, because it's possible they do. Alright, so Ethereum, Bitcoin trying its best. Let's see, how's the volume coming in on this thing? Yeah, it's still not much, so we might get a rally going, but even then, you know, the trend is still relatively down. So until we can start cracking these huge liquidation zones, even having a small rally like this will likely continue in a downtrend. So don't jump into altcoins too quickly, guys. Champ, what the heck? You're late, bro. Nah, don't jump into altcoins too early, guys. Just because you see a rally doesn't mean it's going to have any legs to it. A lot of those rallies are just short squeezes. Right, people who are over leveraging on shorts and being too greedy and trying to follow price, they're gonna get popped. Right, and that's why I tell you guys always wait for the price, never chase the impulse. Trading is hard enough, right? But if you're going to do yourself a real bad time if you're chasing the price, there's going to be rare times where it's gonna work, right? Breakout traders have winning trades as well. The issue with breakout traders is their risk isn't nearly as well defined when it comes to the reward ratio. So breakout traders are so concerned about winning that individual trade that they never see the long term. So eventually they're gonna blow up their account. Even if they're really, really good at it, eventually they're gonna blow up their account because it all comes back down to risk reward. So knowing where the market's going to go next is good, but it's not enough to make money consistently. No, we haven't. We've just been talking about Bitcoin and Tesla a little bit too, if you want, because Tesla had a pretty big day today. For a stock, that's pretty crazy day, 15% move. But you know, Tesla moves pretty crazy, and there's a lot of retail money in there, so there's a lot of money to be made. Meaning, you know, if we get stopped out a couple times, it's okay because all we need is a position that doesn't get stopped out and runs because how high the volatility is. So I mean, something like Tesla, if you wanted to get into options trading, you could do, you know, simple options hedging strategies because you understand that volatility is to be assumed. And so if you get tagged out on one side of your hedge and the other side runs, it should pay for the first side that got tagged out, given that there's implied volatility. So anytime there's a lot of volatility on the stock market, that's when you can start looking at options. If you're going to be trading options when there's not high volatility, then you're going to have to know every fucking nuance to options, and you're going to have to go down that rabbit hole. But an easier way to do it is just wait for high volatility. It makes it a lot easier for everyone involved. Alright, so ETH Bitcoin probably still going to continue down, meaning that we're not going to see any relief in the altcoin markets. Of course, if Bitcoin starts to rally hard, I would expect that the altcoin market would follow suit. So they're kind of reliant on the altcoin market here. Ethereum, which we don't love to see, by the way, they did front run the key level, and when they do that, why is that an issue, guys? Because now what are we doing? We're stacking liquidity in the same spot. So the trade here for Ethereum is let them lose 3K50 again. If they can regain it, now you have your trade. You have a very tight stop loss, and you have your entry idea. Now with this though, because the risk reward is so tight, most of the time you're probably going to get stopped out. But because the risk reward is so tight, it doesn't really matter. Because if you win this trade once, you know, every once in a while, you're going to make up for all the money that you lost the trade on. Okay, so something like this. Now, of course, on the higher time frame structure, there's a chance that this was a huge exchange of liquidity, meaning that if we have this guy on our side, there's a chance that this thing does go on a runner. So we're closing 80% of our position in this range, but given the high time frame action and the bias that we're trading on, there's a chance that there could be a runner on this. So we still want to keep a part of this position open, particularly if Ethereum wants to go on a huge run. So having these little cheeky positions, what do they allow you to do? They allow you to have bigger position sizes, right? The tighter the stop loss, the bigger the position size. When it comes to the risk calculator. So if you're doing your risk calculations and you only want to risk 0.5% of your account, that position can get particularly big if the stop loss is tight. But you have to remember that the tighter the stop loss, the more likely you're going to get stopped out. Regardless of your edge on the market, just logically speaking, the tighter the stop loss, the more likely you're going to get stopped out. That was some epic analysis. I bought some of the coin, $1 worth. At 10 minutes before the police shows up. Yeah, it's that fucking coin, champ. You're gonna get me banned on Twitch because of that fucking coin you recommended. Nice potential long on Adam. Can I check Cocoa? Are you really trading Cocoa? Are you trading chocolates? Chocolate going crazy ever since the Feastables thing started to go crazy. We can look at the chocolate market if you want, but we know that it's mooning right now. And Hershey's is probably good to bet against, but obviously they have a parent company, so. Alright, so what are we looking at here? Adam. Yeah, I mean, the volume is okay. They haven't actually popped the liquidity. Most of the coins have popped this liquidity already, so yeah, not a terrible find. In terms of buying it, though, we are stacking some liquidity to the bottom side. It's struggling really, really hard to hold it. So, if someone is trying to push this thing into the liquidations on the perpetuals, remember, taking out all these perpetual shorts are a short squeeze because, I mean, as you guys know, in funding rates, these short traders have been getting paid funding rates for the last couple of years. So we could eventually come and pop it. Now, if we do pop it, what's the requirement for it to not just be a short squeeze and having a possibility of actually making a new all-time high? All the rigged marbles games. Bro, you guys play marbles, you understand that like there's 30 or 40 of you participating and you still get upset when you don't beat the 1 in 39 shot or the 1 in 40 shot. Yeah, don't get down in the weeds with these meme coins and these shit coins, because here's the thing, if you're not taking profits on them when they're going up, you're gonna lose money. So if you're gonna trade a meme coin, you have to always be scaling out of it and scaling out of it. You can't be greedy and just be like, oh, a little bit higher, a little bit higher. Those meme coins are like Crash on stake, like that Crash game that people like. They just go up and then back down. But still, regardless, I wouldn't waste your time unless you know, the liquidity pools on those coins are not very deep. So getting in and out of positions, you have to rely on the books being pretty thick, which, and those coins, they're not going to be. Alright, so what do we need to see? We need to see an increase in volume. When we pop these highs, if we pop these highs, because we could keep going lower, we need to see an increase in activity. It doesn't have to be an all-time high in volume, but we need to see that the demand is present. Of course, volume includes closed positions as well, but we're mainly using it to identify activity, ergo demand in the financial instrument. But here's the thing: when I look at this, we did front-run liquidity a little bit, so get rid of this arrow. These kind of front runs are not great, particularly when the liquidity is not too far away. So the way you want to trade this is, when it takes this out, it's either going to slide right through and grab all the invalidations, all the liquidations, all the stop losses. Or there's a chance that we're going to rally off of where these stop losses got stolen, okay? So if you're betting the market is going to go up here, or betting the market is going to go up here, where's your stop losses? So what happens is the market does go up, but what happens first? We take out all the most obvious stop losses, these people lose their positions, and it was possible that we could have kept going lower. Instead, though, we came back into the range. So we want to trade with this fucker right here. Now, we need to see if he's still defending, if he's still down to defend his original positions, or if he's mainly hands-off from profit-taking. And the way we can do this, if we can be at the computer, is just identify if they regain this level without losing these lows. Forming a higher low here is good, obviously, because you form higher lows, you have a higher chance of forming a higher high. But we're not taking it off the impulse here, so we're not just, if it bounces and starts to come back up again, we're not just buying it and chasing the price. The reason why we're not doing this is, well, there's a couple reasons. Manipulation can fail, that's a big reason. And so we need to look for our risk-reward, always looking for our risk-reward. The issue, again, with the tighter risk-reward is you're going to lose trades, and it sucks to lose trades, I get that. It's actually in the perfect spot. But what is the long-term goal? To get stopped out a couple times so that you can have a runner, because the runner will pay for everything. But in order to stay solvent long enough, we still have to take profits, regardless of wanting a runner. Because there's no guarantee we're going to get a runner. Most of the time the market will pull back in range. So we need to take profits off the table so we can stay in the game to eventually get our runner. Now the issue with this is when we're waiting for the retest here, instead of buying it here and we're waiting for the retest, what does it do? Well, if our position is right and we get filled at the manipulated level, then we'll go instantly into profit or we'll get instantly stopped out. But if it goes instantly into profit, then what does this confirm? It confirms another higher low. So you have a low, now you have two higher lows on trend confirmation. There's a good chance that we come back into the range. And in this particular scenario, you could actually get a runner because we're still in the we're still in the liquidity zone that's been farmed for the last couple years by the perpetual contracts. So, of course, there's perpetual contracts in cryptocurrency, and the funding rates pay the shorts, long traders pay the short traders. So these liquidation zones have been sitting here for a while. They're obviously not hidden by anyone at this point. So if we do end up cracking these and you see an increase in volume, there's a chance that you could get a runner and we could go and break all-time highs. And a runner like this will pay for 20 losses, okay? Because this runner could, I mean, we can measure it out, but if we're talking about an all-time high, yeah, it's going to be a huge fucking move. Cocoa dumped 17% today? God damn. Alright, yeah, we'll look at Cocoa. What are the prices on the... Oh, is it actually saying 69k? Okay, then this thing that I'm using, the marquee, is just not updated at all. I gotta get rid of the marquee. The thing at the bottom, I thought they updated it from the site that I was using it from, that I was pulling it from, but if the prices are still from, like, the same as a couple months ago, then probably need to get rid of that. It's mainly just a stimulus thing, because, you know, people like to have their eyes stimulated while they're learning as well. Yeah, let's see. Okay, so the price of chocolate had a huge fucking dump today. Not to be surprised, things don't go straight up forever. In terms of shorting it, there could be a potential short at play. I haven't done the proper fundamental analysis on Cocoa to know. But just looking at the price action, yeah, the trend looks like it's starting to bend. So, I mean, you'd want to wait for a daily close that's bad, right? So, let the daily close... If we start to regain this, remember, we still have... oh, my brain is fucking... We still have 6.5 hours until the daily closes. So, I mean, within the next 6.5 hours, if they regain a good amount of this, the daily's not going to look nearly as bad. And when we're coming from an uptrend... usually we're going to continue betting on the uptrend to continue, but this is a pretty big bend, obviously, from a price action perspective. We've taken out all the key invalidation zones from the people that were kind of on the last minute bandwagon of Cocoa. So the people that got in later into the move on the upside, maybe a little bit more greedy, those participants likely just got tagged out of whatever non-restrictive order they had placed there. So whether it be a stop loss, a margin call, whatever it is. But likely we just took out their invalidations. And we had a little bit of a volume peak as well. So, you know, for every sell there has to be a buy. So let the daily play out. We're going to see what it does. If you wanted to be brave, a short opportunity would be sitting here. Let me just mark out the levels. So something like this. Now remember, this is going to be a tight fucking stop loss. And there's a lot of stop losses already sitting right here. So there's a couple ways you could trade it, let it come up. If it already starts to fail it again, and we get that confirmation of another lower high, the second lower high, then you would wait for whatever uptrend, this stampede, to push back against the manipulation, and then look for an entry here, and then using this as a relative stop loss, because waiting for these people to get tagged out is not a terrible idea. Most people don't really care about the chocolate market, though, and I don't blame them. But there is a bit more demand, obviously, as you've seen in the past couple months. The demand is coming through. It's kind of ridiculous to see a commodity moon like this, to be honest with you, but it's the ramifications of inflation, guys. We're going to see these kind of moves to the upside on not only commodities, but as long as the market stays okay, we're going to see it on individual stocks. Which are going to be the more risky plays, by the way. So, I know, we'll get back to crypto, that's what most of you guys are here for, but just having a look at some of the traditionals, seeing how they function. The rest of the altcoin market looks like it's getting slammed pretty hard today. There's a couple ones that are doing okay. Let's see. So Solana's still struggling pretty hard. This price action is not looking great, boys. It's getting its ass kicked out here. The volume is still coming in. It's starting to drift off a little bit, so we are tapering off with the volume. In these kind of cases, I'd be looking to go to bet against this market. However, of course, if the crypto market continues to pump, then Solana will probably follow suit. Might not pump as much as the other coins or the other or Bitcoin, but you know, generally the market follows the same sentiment, particularly when the sentiment is very strong coming from Bitcoin. So if Bitcoin's up 10% on the day or down 10% on the day, that should be reflected in the altcoins. Nonetheless, it's not bad to bet against certain markets in the crypto space, particularly if you're already up. If you're already making money in the crypto space from having a position that's in profit, it's not the worst idea to bet against certain things. Obviously, when you do bet against things and your bias is still bullish, you don't need to be risking a ton of fucking money. So there's a couple trades I see here, if you want to be really aggressive with it. The first trade I see is the retest of where the liquidations happen. Now this is going to be a tight fucking stop loss, and you're going to be sharing a stop loss with a lot of people. So this is probably going to get tagged out. But the risk reward on it is really, really good. So this would be a really low risk trade with the intention of likely getting tagged out. It'll likely get tagged out. Now if it does get tagged out, what does that mean? We're clearing this liquidity here. So the people with invalidations here, we're going to get a flood of market buys that come in. Why are we going to get a flood of market buys that come in? And it's not just, I'm not just talking about people buying. The flood of market buys coming in is when a short position gets closed or stopped out, it operates as a market buy in the books. So we should see a flood of market buys, which will do one of two things. Either increase the price, which is the natural move of what should happen, or fill the orders of a bigger trader. So a trader that has an issue with getting their orders filled could find enough liquidity in this zone to do so. And if we see that and we push back into range, then how are we going to trade it? Same logic that we're using here. We're waiting for the retest of where the orders started to get stolen. So if this was the most obvious stop loss for the people that were betting the market is going to go down, we tag that out, right? So these people here betting the market's going to go down. Where's the outlier in the data? Where's the most obvious stop loss? They get tagged out and sent back into the range. So now the first trade would be to go with this guy. If this guy loses, then we'll go with this guy. But it's potential that if this guy loses, the natural move of the market will just be up. If it's not up, then there's a potential for a trade. But this is if you want to be really aggressive about trying to short it. And then obviously from the more of the logically fundamental standpoint, I mean, when you're talking about store of values, which is what this asset class is trying to be defined as, if you're trying to be a store of value, you still need to produce volume. And if the volume starts to taper off, it's natural that the market will slowly start to bleed. If that's the case, then yeah, if we can see that the volume and the activity in the coin is dying a little bit, and the price hasn't reflected that yet, then there is opportunities to bet against that market. And those opportunities are going to be founded where other people lose. So we're trying to identify the most obvious stop loss because we're trying to identify where the most amount of people lose their positions, and then we want to observe what price does in that spot. Because the truth of the matter is, when you lose, when you get stopped out of a short position, it operates as a market buy. I know I say that a lot, but I want you guys to remember that when we take out certain highs, yes, of course, there's people who see a new high and they buy a new high. Okay, those people exist. They're not very successful in the market, but they'll always exist. But the main volume that's coming through there is all of the margin positions getting stopped out, or in some cases, liquidated. So of course the price should continue to go higher, right? If these people are getting stopped out and liquidated, and there's buyers coming in, then the price should go higher, right? But sometimes the price does what? It takes out the high and pulls back into range. So what is that telling us? It's telling us that somebody just absorbed a lot of positions, and likely, if they're hedged, they closed some of their positions in profit in order to swing the market. Now, the market's not guaranteed to go up or down. It never is. That's why people hedge. However, when we're looking at the middle of the range versus the outside of the range, there's going to be a little bit of bias coming in from what occurred on the outside of the range. Because the outside of the range is telling you a story, right? The story is one of two things. When we take out this high, we could either go and make a significant high, or we could fail back into the range. Both these options always exist on the market, but it's telling you in the price what's happening. Remember, guys, the price cannot lie to you. Yeah, 17% for a commodity is pretty crazy, but cocoa's also been having really good upward days too on Volt. So, I mean, it's to be expected, right? Things don't go straight up, straight down.